Sure. Yeah, that sounds great. So I think one of the things that we'll talk through here this evening is the velocity of money, specifically around life insurance and earning multiple rates of return on a dollar. And to much of your audience, similar to how I operate, is utilizing the velocity of money specifically with how it relates to real estate. Okay. Can you see my screen, Dennis?
Yep. Yep. You're good.
Great. The financial institutions typically want us to relinquish control of our money for long periods of time, let it sit idle, and earn a rate of return. And as a result of that, what we realize is that the banks ultimately could more frequently, or the financial institutions more frequently, get multiple uses of a dollar. So when we look at how banks make money much differently than the way individuals are told to make money, we're told to put a dollar, let the dollar sit, let the dollar grow. Yet banks make money through fractional reserve lending, or as we call it, the velocity of money. So if we have a dollar on deposit, the bank's taking that money and lending it back out to someone on a mortgage, and that person's paying the mortgage payment, and they're taking that dollar and lending it back out to someone to finance a car or through credit card purchases. Through the fractional reserve system, banks have the ability to lend money 10 to 1 for what we have on deposits. So while they're telling us to lock our money up and let it sit for long periods of time, they're creating wealth for the financial institution by recirculating that dollar multiple times and earning multiple rates of return on that dollar. Okay. When we talk about having money grow efficiently and effectively, we like to talk through concepts and talk through different ways where clients could earn multiple rates of return on dollars. Now, as Dennis, I don't sell real estate. I'm not in the investment business. These are just conceptual conversations around how money works and how to build protection around a financial strategy. But real estate is a good example, as I know you and your audience is very engaged in, on how you can begin to earn multiple rates of return on a dollar. We're often told that in order to earn a higher return, we need to take more risk. And in order to get that, if we take that risk, we could earn more reward. Yet if you look at how wealthy people invest into real estate, their objective is not to take an abundance of risk to earn a rate of return. And when you buy a piece of real estate, if you wanted to earn a 20% rate of return, the goal wouldn't be to buy the most aggressive or speculative piece of real estate and hope that appreciates in value. Yet, you could buy a moderate piece of real estate that the numbers make sense, and you could earn a small return multiple times on that dollar. So for example, we buy a piece of property, and over time that land will appreciate in value. We can anticipate that land appreciating since inception. I think they say real estate appreciates at around 5% per year. Okay. In addition to that 5% return, so while that property is increasing in value, we're also receiving some tax advantages. And this changes obviously with the tax code year by year. Currently, there's some real advantageous tax benefits, specifically to depreciation and cost segregation studies therein. But the structure of that building has a schedule that the IRS allows you to write down against income on that property. That depreciation is a measurable return. And if we call that a 5% return, where that helps is on that rental income. So the rental income is the net cash flow, which is the gross income minus the operating expenses of that property, which is what the investor puts in their pocket. And if that was, say, 5% of what the down payment was, that might not have a taxable event if there's depreciation on the property that could potentially wipe out that income, thereby adding an additional rate of return, a phantom type of a return. And then lastly, you have a mortgage, and a mortgage earns almost multiple returns within and of itself, thereby earning leverage on a down payment. So you're putting down, let's say, $100,000 buying a $400,000 property. And as that property increases or appreciates, you're getting the appreciation on the $400,000 number, not the $100,000 number. And in addition to that, that mortgage interest is tax deductible. And unlike a personal tax return for investment real estate, there's no limit on that because it's an expense. So through real estate, you're earning small rates of return multiple times, and it's a great example of the velocity of money and how to earn multiple uses of a dollar. When our clients begin to understand that money is designed to work in motion, not linearly, the way we're told to have it work,